So by the time the contract got bid and the replacement or the cost basically to rebuild this building came back, it had been 5 years since the appraisal, plus COVID, plus all the other things. And ultimately they got $1.1 million from insurance, and it cost a little over $1.8 million to build the building back. So the values were short by $700,000+.
Significant. Hello and welcome to Policy Party. I'm Negar Sharifi, joined by my partner, Phil Masi. Today's topic, we're going to discuss insurable replacement cost appraisals. How often you're supposed to get them, why they're important, and the impacts they have on insurance. So Phil, I thought we would open today. You and I have both personally dealt with this situation before. And it is associations that either have past due appraisals, and I want you to talk about what's past due, or appraisals that are a few years old, maybe even 2 years old, and are in compliance with statute. So what I would like you to talk about first is, let's first start by digging into what the statute says we have to do. So 718 statute, if it's one thing they're sticklers on and they're pretty firm on, it's the appraisal. Can you start us off by discussing how often we're supposed to get it done?
Yeah, so statute says every 3 years. It used to be 36 months, now it's 3 years, which is the same thing, which is why they changed that, I don't know. Required to get an insurable value appraisal and base the insurance replacement cost that you're insuring the buildings off of that appraisal that you have. So every 3 years, essentially, you want to get an update to the appraisal you had before. And the reason for that is you want to keep up with what the replacement cost values for the buildings are. And the replacement cost per square foot of every type of construction has been wildly different today than it was 10 years ago. And if you look earlier on in our careers, it used to be like a 3% inflation jump a year. That has not been the case the last few years. I mean, COVID changed the game on that versus what went down with massive types of increases in valuations. And now as we're going through this war and all the issues you hear about the Strait of Hormuz being closed and everything else, I mean, you can't have crude oil and barrels costs go up from, 70 to $1.14, $1.20 and not have some impact on construction costs.
So
it's constantly changing.
Okay, so I just want to kind of pause because it's important for our property managers and our boards to understand what Phil's saying right now. How does the economy impact the appraisal for the association?
So the association's appraisal is the replacement cost appraisal. It has nothing to do with sales value. Okay. So your buildings can, sell in a market like in 2008 where it was the bottom of the barrel of the market, or in a market that's blown up like it is today and the values are really high for sales value. Sales value is not what we're taking into account here. Insurable replacement cost value is going to literally be what the association is responsible to replace if that building disappeared tomorrow. So in our world, if the building was scraped and gone, you're not having to buy land. You're not having to redo foundations. It's just building that shell of the building that was there. And that's what the appraisal is looking at. It's carving out the interior on a 718 condo association that the unit owner is responsible for. So it's just what the association is responsible to replace. And so the replacement cost per square foot of that changes depending on what's going on in the economy and in the world, right? Because you've got labor cost and you've got material cost.
So step one, labor, is a large source of construction labor, particularly in Florida.
Yep. Has
been the migrant group, which we all know in the news. They've been putting the pressure on migration, right? So less.
Yeah, you have less, absolutely, lower labor force about people to do some of the work that needs to be done. So you're obviously getting pressure on the labor market, causing, labor prices to go up to get the crews to do what you need to do. And then obviously material cost, which is largely driven by the cost of oil, which is in turmoil right now.
And tariffs.
Correct. The tariffs, tariffs on steel, on lumber, all that. So you definitely have a three-headed kind of monster impacting the replacement cost of stuff. And, back in the day, I say back in the day, we've been doing this 20 plus years. When you go back 10, 15 years ago, I feel like we would insure frame apartments and frame condos for $60, $70, $80 a square foot. That was like finishing and everything. That's changed a lot since then. And unfortunately, I don't think any of the values we're using now are even really adequate when you see what actually costs to replace these buildings when they go to bid. We can only work on what the appraisal is giving us, but I don't necessarily see situations where our values in the appraisal are way overvalued. If anything, I still probably suspect, on there. And I think we have some good examples.
We do. So we both do. I'm going to have you discuss one. But before we get to that, oftentimes I've heard the clients I work with say, well, if we get an updated appraisal and we do think the rates or the replacement cost value is going to go up, but doesn't that mean we're going to pay more for property insurance since the limits are going up?
Yeah. So property insurance premium is based off two numbers, value times rate. So if the rate, which in this market right now is coming down, which is a good thing.
Yeah.
But the values, if they're going up, is obviously it works, it's two numbers multiplied by each other. So if either side of that equation goes up, it can go up. What I would tell you is the value is going up by, let's say 5% and the rates are going down by 10 or 15 or 20 or whatever it is, you're going to be fine. What killed us was in 2022, 23, in those markets where you had crazy value increase and crazy rate increase at the same time. Those two things will, they impact each other. So if you had, a certain percentage here, 30%, people think, oh, it's just 60. It's not, it's 69, right? Because it compounds on one another because you're doing more rate on more value. So it's not just a simple equation. And so if they were both going down, it would drive it down. I just don't know in 21 years of I've been doing this that appraisal values have ever really gone down. I think in 2008 is probably the only time, 2009, where the economy was really bad and there was, obviously labor, the cost of labor went down significantly, the cost of oil went down. You did have a scenario there where we saw appraisals starting to trend downward, but every other year in my 21 years of doing it, they usually go up because the price of construction and labor and materials is constantly increasing with inflation.
So, Phil's going to get into the risk of not being in compliance with the statute and getting it done every 3 years, the appraisal. But the flip side to that is a lot of times lenders are going to require to either see copies of an appraisal. They'll ask, when was the last time an appraisal was done? Where did you get this valuation from? So correct. So some of these communities have to produce proof of an appraisal. Explain to us how the insurance payout were to work in the event of like a fire burning down a building. If they look at the bottom, they're like, oh, we have 15 million. If we lose one building, that maybe only costs 3 million, we should be good, right?
Yeah.
The answer is no, right? So can you dig into why?
So when these condos, most of the carriers that do this, they're creating they're insuring the buildings in a values per location. So if there's 15 buildings and they all have $1 million of replacement cost value, so 15 identical buildings, you may have 15 million in coverage, but the most it'll pay out for any one building is $1 million, the amount you insured that building for. So you can't rely on this being like a blanket limits deal for these condo associations.
Because you're only going to get the max of what it shows on your proposal for that building. Now I'd like for you to share, and I went through a very similar situation with one of my condo communities. Share what happened to one of your condo associations that had a fire.
Yeah, so I had a big association actually in Lake Mary, frame construction, 1980s, garden style, similar to almost everything we insure. And they had an appraisal that done in 2017, and they had a bad fire in 2021. Now, when they renewed the 2020 to 21 policy, that appraisal in 2017 was within 36 months. So they were in compliance, but a lot had happened in those years, if you remember, with COVID and everything else. But what I guess I hadn't seen in real life happen was that this building completely burned down. Carrier paid full policy limits, like 1.1 million. They were like, here it is.
They just wrote a check.
1.1 million. That's what usually happens, right? If you have a complete building, total loss, policy limits typically pay. So you would think, hey, we insured this building for exactly what that appraisal said to insure it for. We got the 1.1 million. We should be good. But no association bids this and has this building being rebuilt in 60 days. I mean, this takes time. So 18 months later, the association is still going through dealing with the contractors and getting the work done. So by the time the contract got bid and the replacement or the cost basically to rebuild this building came back, it had been 5 years since the appraisal, plus COVID, plus all the other things. And ultimately they got 1.1 million from insurance, and it cost a little over 1.8 million to build the building back. So the values were short by $700,000+.
Significant.
And so I think a lot of associations don't understand what the impact of not having the right appraisal. They focus on things like, oh, my insurance premiums may go up. But I mean, if you're in any type of garden style, especially where you can lose an entire building due to a fire, which I could tell you most of our frame buildings, when they have a bad fire, the entire building's gone. That's the real threat, is just being well underinsured. And I have associations that I believe are very, well insured. Still, the cost that comes back when you need to rebuild that building, it's never the day you have it happen. It's months later. So you're already going to be, backwards from that appraisal. And if that appraisal's got any age to it, you just got to think about those things. I think that's the biggest reason why you want to keep that updated. And again, at least every 3 years, but we have associations that will look at it on an annual basis, every 2 years, but you got to keep up every 3 at least, because the market's changing too much.
And there you have it. This is a topic that often comes up. And so today we wanted you to know all the specifics about why it's so important to make sure you're up to date on your replacement cost appraisals. Thank you for joining us today. I'm Negar Sharifi. He's Phil Masi.